This is Optimal Finance Daily, episode 1034. Is it risky borrowing money to invest? By Chris Reining of chrisreining.com. And I'm Dan, I'm your host, and this is where I read to you from some of the best blogs on personal finance, and I'm here every single day bringing you this great content, including weekends and holidays. And we've actually got 5 shows where we do this same format but covering different topics. You can search for Optimal Living Daily wherever you're hearing this to find all 5 of our narration-style podcasts. But for now, let's get right to our post from Chris as we continue optimizing your life. Is it risky borrowing money to invest? By Chris Reining of chrisreining.com. Today's question comes from Jeremiah. He asks, quote, "Hey Chris, obsessed with your website and advice. Keep up the great work. I had a question I wanted to run by you. I was looking online at smaller loans and came across some pretty decent terms and had an idea I wanted to see what you thought about. I can borrow $15,000 or possibly more for around 3% interest for 3 to 5 years, my choice, and was considering doing this and investing that cash into ETFs, index funds, mutual funds, etc. Now, I know the first reaction is probably, why would you borrow money to invest? Fair question. My thought process is I can borrow this money at 3% interest and more likely than not be able to get a much greater return than 3% over that 3 to 5 year term. Maybe I'm just being really naive here. Please tell me if that's your honest opinion. But I'm really wondering if you think this would be a good idea. Can you help me see where my faults are if you don't agree?" End quote. Since 1871, the stock market has returned about 9%. People will say the market won't have those same returns going forward. That's fine. People have been saying lots of things for a long time. Still, what you're talking about doing is a bad idea, and I'll tell you why. No one on this planet, economists, analysts, strategists, know where the market is headed in the short term. On average, the market falls 10% once a year, about 20% every 4 or 5 years, and about 30% every decade. So can you tell me what happens when you borrow $15,000, your investments rise 9% the next 2 years, but then fall, say, 20%? Here's the math. The first year, your $15,000 rises to $16,350. The second year, $17,822, and the third year falls to $14,258. Now your loan's due. In reality, that's not how this would work. A loan requires you to make monthly payments. You're constantly selling investments that need to be in a taxable brokerage account, so you're also paying short-term capital gains tax. The way investors typically borrow money to invest is with margin. You apply for margin in your brokerage account, borrowing money from your broker. Let me tell you a story about margin. There was this 20-something investor who bought a small amount of this biotech stock called Celera. The stock started doing well, so he continued buying more, but this time using margin. All of a sudden, the stock started falling from a high of $276. He's thinking, what idiots, and uses margin to buy more shares. He can't believe it when it falls to $170. He buys more. Stunned as it falls to $150, he buys even more. And when it finally hits $130, he sells every other stock he owns, raising all the cash he can, and margins himself to the gills. He's convinced the stock is going to rebound, and when it does, he's going to make a massive profit. It then falls to $85. At this point, his broker is forced to sell his entire position in order to cover his margin debt. Yeah, his $60,000 brokerage account, which took 3 years to build, is wiped out in just 2 weeks. Worse, he now owes his broker $1,500. As for Celera, it was eventually acquired at $8. You see, investing really has nothing to do with money. It's mostly about avoiding bad decisions, and I started using decision trees to help with this. After all, I'm human and make emotional and psychological mistakes just like everyone else. Here's a personal example. I like keeping 3 to 5 years of living expenses in cash. Should that be sitting in cash, in a money market fund, or invested? What's the best decision? Decision number 1, cash earning 0%. $1,000 times 1 is $1,000. Decision number 2, money market fund earning 2%. $1,000 times 1.02 equals $1,020. Decision number 3, invested earning 9%. $1,000 times 1.09 equals $1,090. Investing is the best decision, but also the only decision that involves risk. Remember, on average, the market falls 10% every year, about 20% every 4 or 5 years, and about 30% every decade. And because there's no way to predict if you're going to get caught in a decline, you need to incorporate uncertainty into the decision. Here's how you do that. Let's say you think there's a 40% chance the market falls 10%, leaving you with $900, and a 60% chance the market goes up 9% and you'd have $1,090. To evaluate this decision, you need to work backwards. $900 times 0.4 plus $1,090 times 0.6 equals $1,014. This means you'll probably get worse returns from investments earning 9%, $1,014, than from a money market fund earning 2%, $1,020. Decision trees aren't perfect, but they are a useful tool to think through options to make the best decision. Make sense? We've been in a bull market since March of 2009. The market has returned over 300%, so anyone invested in this time frame has made money. And if you've been borrowing money to make money using margin, it's magnified those gains. Your spouse thinks you're smart, your friends are jealous, and you're sitting there thinking borrowing money to invest was a good decision. Okay, but what happens when the market falls? Like Warren Buffett famously said, only when the tide goes out do you discover who's been swimming naked. You just listened to the post titled, Is It Risky Borrowing Money to Invest? By Chris Reining of chrisreining.com. And that'll do it for this installment of Optimal Finance Daily. Hope you have a happy rest of your day, and I'll see you back here tomorrow for the Thursday show, where your optimal life awaits.